What if I told you there's a US energy company paying a 6.88% dividend, just raised it again, and posted rock-solid Q1 earnings, but no one's talking about it? Is this the safest high-yield stock in the market right now? Let's find out. Enterprise Products Partners, established in 1968, is one of the largest midstream energy businesses in North America, providing a wide range of services to producers and consumers of natural gas, crude oil, natural gas liquids, NGLs, petrochemicals, and refined products. The company owns an extensive network of pipelines, storage facilities, processing plants, and export terminals. Enterprise generates revenue through long-term, fee-based contracts for services like transportation, processing, storage, and fractionation, helping customers move energy products from production sites to end markets. The company is currently offering a starting dividend yield of 6.88%, while the 5-year average yield stands at 7.52%. The current price to DCF ratio is 8.2, compared to a 5-year average of 7.7 and a sector average of 8.6. The expected fair value range for the stock is between $26 and $32, while the current market price is $31.68. Based on these metrics, the stock appears to be fairly valued at the moment. The company currently pays an annual dividend of $2.18, distributed on a quarterly basis. The next dividend payment will be on August 14th, and shareholders must own the stock by July 31st to be eligible. The dividend has increased by 4.1% over the past 12 months. The 5-year average dividend growth rate is 3.5%, while the 10-year average is 3.8%. The company has consistently paid and increased its dividend every year for the past 26 years. The DCF Payout Ratio has been showing a declining trend for years and is currently more than 30% below the expected level. Further decreases are anticipated in the next 12 months, which is very reassuring, especially for a company with a starting dividend yield above 5%. DCF share is steadily increasing year after year, which is very important as it indicates the company can continue to pay and raise dividends in a stable manner. DCF per share growth and sales growth are quite volatile, but this is not surprising in this industry. The company also started a share buyback program a few years ago, which is something every investor likes to see. Total sales are also quite volatile, similar to the DCF and sales growth, which is completely normal. Net debt to EBITDA has been on a nice declining trend for years and is currently well below the expected level of 4.5. Net debt to capital is also below the expected maximum level, and the interest coverage chart looks very strong. The company is currently available with a starting dividend yield of 6.88%, and the dividend was increased by 4.1% over the last 12 months. The credit rating is A-, which is considered good, and the dividend also appears to be secure. Based on these factors, the company is currently available at a fair price in the market. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Let's start with what income investors care most about: dividends. In Q1 2025, EPD paid a distribution of 5.35 cents per unit. That's a 3.9% increase year over year. But here's the kicker: since this report, they've already announced another dividend hike. The next payout will be even higher, and it's scheduled to hit accounts in August. So, while most companies are freezing or cutting dividends, Enterprise is doing the exact opposite and rewarding unit holders consistently. And it's not just dividends. In Q1 alone, they repurchased 1.8 million units worth $60 million, showing that management sees real long-term value in their own stock. Total capital return to investors over the past 12 months, a massive $4.8 billion through distributions and buybacks combined. Now, what about the company's ability to sustain those payouts? The answer lies in cash flow. EPD posted a trailing 12-month payout ratio of just 56%, and their leverage ratio stands at 3.1x, right within their target range. This company doesn't overextend, and with $3.6 billion in available liquidity, they're more than prepared for macro shocks. Even more impressive, They've raised their distribution for 26 consecutive years, through recessions, oil crashes, and even the pandemic. And they're not sitting still either. Right now, they have $7.6 billion worth of major capital projects under construction, most of it tied to natural gas and NGLs in the Permian Basin. Nearly $6 billion those projects are coming online in 2025, meaning more cash flow, more throughput, and more value for investors. Now let's look under the hood, segment by segment. Total gross operating margin came in at $2.431 billion, just slightly down from last quarter and flat versus last year. The NGL segment carried the team again, contributing $1.418 billion, up from $1.34 billion a year ago, thanks to increased volumes in the Permian and higher ethane exports from Morgan's Point. Natural gas and refined products showed strength too, but petrochemicals and crude oil saw margin compression, mainly from lower spreads and weaker pricing. So let's zoom out. You've got a company with growing cash flows, a 6.88% yield, 26 years of dividend hikes, and billions in growth projects coming online soon. In this market, that's rare. Enterprise Products Partners may not be flashy, but for long-term income investors, it just might be one of the most reliable plays out there. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.